Good morning and welcome to the Killik & Co market update. It's been a couple of weeks since the last video, so let's have a look at how markets have performed during that time. Here's the S&P 500 over the last 3 years, and you can see it hit quite a low point last month, about 4 weeks ago, but since then it has recovered quite nicely. However, although stocks are up, it's also worth looking at how currencies have performed, because these can have quite a bearing on the performance of global portfolios. Here's the pound versus the dollar over the last 3 years, and you can see there's been quite a lot of big movement here. At some points last year, £1 would buy you over $1.40, but last month that dropped below $1.25. Even though a stronger pound might be good news if you're going away on holiday, it's actually bad news if you have a global portfolio. As the pound strengthens, that means that dollar-denominated stocks will be worth less in sterling terms. Interest rates are a key driver of exchange rates. If a country raises its interest rate, that's likely to cause a strengthening of its currency. The UK and the US are expected to raise their interest rates over the next couple of years, and this week even the European Central Bank decided it was going to raise its rates by 25 basis points in July. Future exchange rates will be determined in part by the relative interest rates between different countries. In contrast to American stock markets, Chinese stocks performed very poorly in 2021. Here's the Msci China index, and you can see it lost over a third of its value in 2021 for various different reasons. One was the regulatory crackdown on the Chinese tech sector, one was the ongoing US sanctions on China, and another was the ongoing strict lockdown policies imposed by the Chinese government. However, during the last couple of weeks, some of those lockdown restrictions have started to be lifted, and you can see that's led to a slight recovery in the Msci China index. However, this week, some parts of Shanghai have been placed back into lockdown because of the Chinese government's zero COVID policy. If the government continues with this zero COVID policy, it's likely there will be ongoing lockdowns for many months to come, and therefore it might be worth considering whether you want to continue holding Chinese stocks in your portfolio. And finally, there have been some negative headlines relating to the house building sector. Firstly, the end of the Help to Buy scheme has brought forward, and properties must now be reserved by October this year. Previously, some of the major house builders have made over 50% of their revenue from this scheme, so the end of it could have quite a big impact on them. Also this week, there's been the results of a survey by the Royal Institute of Chartered Surveyors, and it says there's been quite a notable drop in new inquiries for houses over the last couple of weeks, and this makes sense considering that interest rates are on the rise. And to add to that, some house builders are suffering from rising costs and also rising wages. Here we've got a chart comparing the share prices of 3 major house builders over the last 10 years. We've got Berkeley Group, we've got Taylor Wimpey, and we've got Persimmon. And you can see that all of their share prices have sold off quite heavily over this year so far. Please do give us a call if you'd like to talk about anything mentioned in this video, or otherwise you can email info@killik.com. Next week, we're looking ahead to results from Tesco. That's it from us. Enjoy the weekend, and we'll see you next Friday.